Ladies and gentlemen, I hope I'm not interrupting your lunch and I hope you're also enjoying your lunch หวังว่าทุกท่านคงจะเพลิดเพลินนะคะกับอาหารสุดพิเศษนะคะที่ทาง AIA ตั้งใจที่จะเตรียมให้กับทุกท่านในวันนี้นะคะและตอนนี้ค่ะก็มาถึงช่วงเวลาสำคัญนะคะที่เราจะต้อนรับนะคะคุณนิคิล แอดวานีประธานเจ้าหน้าที่บริหาร AIA ประเทศไทยนะคะขอเสียงปรบมือต้อนรับท่านด้วยค่ะ Please welcome คุณนิคิล แอดวานี Chief Executive Officer of AIA Thailand to deliver his welcoming speech
Sawadee Krap, distinguished guests, partners, ladies and gentlemen, a very, very warm welcome to all of you and thank you for making the time to join us this afternoon. It is my absolute pleasure to host the AIA Nobel Laureates Luncheon Talk facilitated by the International Peace Foundation today. As many of you know, AIA has set an ambitious goal to engage 1 billion people live healthier, longer and better lives, and we aim to do that by 2030. We are also committed to achieving net zero emissions by 2050, and so we are dedicated to creating a more sustainable future for everyone that is included in our contribution for caring for this planet. During the past decade, climate change has become one of the key risks that has impacted communities around the world and in many aspects, including its impact on global economic conditions. AIA, as the largest pan-Asian life and health insurer, has significant assets, and as an investor, we recognize the scale of positive transformation that we can make to helping people live healthier, sustainable, and better lives for generations to come. Our ESG strategy is built around 5 key pillars: health and wellness, sustainable operations, sustainable investments, people and culture, and effective governance. Together, we believe that the integration of these pillars contributes to a sustainable and healthier development for the people in our communities and ultimately for our planet. I'm truly honored to be a part of this exclusive opportunity to hear from Professor Robert Engle, Nobel Laureate for Economics, on how organizations can foster global cooperation in addressing climate-related economic challenge and create a more sustainable future for all of us. Most importantly, I hope that the Nobel Laureates talk will facilitate the exchange of valuable knowledge and ideas among the great minds in this room. So, without further ado, I'm going to say welcome to Dr. Engle, and I'm going to say enjoy a great speech and great afternoon. Kapun kap.
ต้องขอบพระคุณเป็นอย่างสูงนะคะสำหรับคุณนิคิล แอดวานีประธานเจ้าหน้าที่บริหาร AIA ประเทศไทยนะคะที่ได้ขึ้นมากล่าวต้อนรับทุกท่านอย่างเป็นทางการนะคะและท่านก็หวังเป็นอย่างยิ่งนะคะว่าที่ AIA ตั้งใจจัดงานในวันนี้ขึ้นมาเนี่ยนะคะจะเป็นประโยชน์แก่ทุกท่านนะคะซึ่งถือว่าเป็นพันธมิตรที่สำคัญต่อ AIA นะคะแล้วก็จะได้นำไปสู่ความร่วมมือนะคะในวงการประกันแล้วก็สถาบันการเงินด้วยนะคะอันจะก่อให้เกิดประโยชน์สูงสุดให้กับประเทศไทยต่อไปค่ะแขกผู้เกียรติทุกท่านคะในลำดับถัดไปนะคะดิฉันต้องขอเรียนเชิญศาสตราจารย์โรเบิร์ต แองเกิลนะคะผู้ที่ได้รับรางวัลโนเบลสาขาเศรษฐศาสตร์ขึ้นบรรยายในหัวข้อ A Financial Approach to Climate แล้วก็สำหรับท่านที่มีคำถามนะคะกรุณาสแกนคำถามของท่านนะคะผ่านทาง QR code ซึ่งตั้งอยู่บนโต๊ะของท่านนะคะเดี๋ยว Professor จะมาตอบช่วงท้ายของงานนะคะ Ladies and gentlemen, here comes the highlight of today's event. I'm honored to welcome Professor Robert Engle, who was awarded the Nobel Prize in Economics for his research on the concept of autoregressive conditional heteroscedasticity, or ARCH model, which led to the proliferation of tools for analyzing stocks and enabled economists to make better forecasts. In 2003, Professor Engle was recognized for developing methods for analyzing economic time series with time of varying volatility due to his research in the decades prior on mathematic techniques for evaluation and forecasting of risk, which was beneficial to financial market analysis, especially for assets that could face volatility from various risks, including climate risks. Let us hear more from Professor Engle on his perspective on climate challenges and how we can better address these risks. Ladies and gentlemen, please join me in welcoming Professor Robert Engle for the highly anticipated talk on the subject of a financial approach to climate risk. A big round of applause to welcome Professor Robert Engle.
Thank you very much for that kind introduction. And thank you to AIA and thank you to Kun Nick for inviting me here. And I want to say also a thanks to the International Peace Foundation for organizing this whole trip and my speaking arrangements. I want to talk to you today about climate risk. And I'm going to talk to you from a financial point of view, and it bears a little bit of a relationship to the Nobel Prize, but not too much. I'm going to tell you what that relationship is, but then I'm going to talk a little bit about how at the Volatility and Risk Institute at New York University, we're analyzing the financial structure of climate risk, how we're measuring it, how we use that measurement in actual behavior, and then talk finally about some current events to understand what we see in these risks today. So this is the wrong set of slides. We just changed them. Well, maybe it's okay, and maybe it probably doesn't matter. So this is the Nobel Prize. This, you may not know what it looks like, but that's what it looks like. But instead of it being this big, it's this big, and it sits in a drawer. But what is it for? I get asked so many times what it's for, and you just heard one paragraph answer as to what it's for. When I first got it, I couldn't say it even in a paragraph. I had to say it in an hour lecture. I've learned to say it in one sentence. It's a statistical model that's used to predict risk in financial markets. So we want to be able to predict risk. And this is a very easy to understand idea. There is some statistical analysis of this, including the word heteroscedasticity, which you just heard, but we're not going to have to deal with that today. But we do want to talk about risk. And the first thing I want to show you is some ways we measure risk at the Volatility and Risk Institute, which I co-direct. And we have a website which, if you choose, you can see on your telephone just by typing in this URL. And one of the first things you'll see is a description of where volatility is high. And on the left is the country volatility that's highest, and you see Turkey is on the top of that list. In the lower left is where currencies are volatile. On the upper right is where industries are volatile, and in the bottom right is commodities. So this is just a summary of something like 10,000 assets that we look at every day as we measure volatility and post them on the internet so people can see where risks are greater. Another way we post them is on a map. So here is a map of where volatility is high. And green is where it's low, red is where it's high, and it's a nice thing to look at periodically when you first open this website. Where are the risks? Where is risk high? And the answer is here: Argentina, Mexico, India, China, maybe Saudi Arabia, and so forth. But not so much in the US, and not so much in Thailand. So when we use these models to measure risk, we're typically looking at the risk just a few days away. In other words, when we talk about the volatility of stock market, if it's high, it means that there's a bigger chance that it could go down substantially over the next few days. if we want to know about longer run risks, we might need different tools, and that's what we want to talk about today. We want to talk about climate risk, which is clearly a longer run risk. And the science of this is pretty well understood in a lot of ways, I think. The world is warming, and it has enormous consequences which economists are spending time trying to figure out. It will lead to presumably lower productivity, population migration, stranded assets, such as fossil fuel reserves, or maybe more importantly, stranded assets like capital and land, which are no longer going to be productive. It will lead to global conflicts and reductions in the quality of life, and in the most disastrous outcome, the end of our species. The thing is, we see already impacts of climate change. This weather we're seeing outside here is evidence that the climate is changing. This is especially warm for this time of the year, apparently. But we also see major storms. We see deluge of rain in some places and droughts in other places. I've been told that the salinity of the rivers in Thailand is increased because the sea level rise is pushing salt water upstream, and there's not enough rain to bring it back to the sea. There are all sorts of things that happen as a result of this global warming. But most of these consequences that we see today are small compared to what we can foresee in the distant future. We think that the worst of these damages are still likely quite far in the future. And so we have to decide what to do today as a consequence of these risks that are in the future. And asset prices and finance is a way of thinking about this, because asset prices reflect the long-run risks that are coming down the pike. And asset prices today are therefore an indicator of what to expect. But they are also the leaders that tell you where the money is going to go. So the response to climate change is driven by today's asset prices. So, for example, if you think we need more investment in renewable energy, that will be much easier to make happen if renewable energy stocks are high, so that there's some profitability in building new renewable energy resources. If we're saying it's just because we personally think it's a good idea, but it's not profitable, we're not going to get nearly as much financial support for it. So that we need to use these asset prices to monitor and direct investment to solving climate change problems. So you may wonder whether expectations of the future are really very accurately priced in today's market. But just a simple little example here at the end. When you look at the stock of Tesla, it's about 60 times its current earnings. When you look at the stock of GM, General Motors, it's about 5 times its earnings. Why is that? Well, we think that Tesla has a much more profitable future and a much longer horizon future than maybe General Motors does. So expectations show up very powerfully in today's asset prices, and that's what we're going to be looking at. So to start from the beginning, what do we mean when we talk about risk? A risk is an event that's in the future. It's typically a bad event that's in the future, and it has some probability of occurring, and if it does occur, there's going to be some bad consequences. So we need to understand what the probabilities of these risks are, and what the consequences of the risks are, in order to decide what to do. Should we avoid the risk? Should we try to change the probability? Should we try to change the impact? Whatever. If these bad events are in the distant future, we call this a long-run risk. And climate change is mostly about long-run risks. We could think of this as long-run risks of hurricanes and droughts and temperature rise. But we also want to think about this as the long-run risk of our policy response to this. We need to know, is our government and other governments around the world, are we going to respond in a creative, impactful way to these kinds of physical dangers that are on the horizon? And the uncertainty of the political response is probably even greater than the uncertainty of the physical responses that are coming. So I'd like to start with an example. And this is just a simple way to think about a new type of risk that I think is important. Suppose you're the owner of a beachfront luxury hotel. There are many such hotels in Thailand, I'm sure, and there are long-run risks associated with owning these hotels. But one of the long-run risks is that sea level rise is ultimately going to destroy this hotel. There's not much the owner can do about it, but you don't know when it's going to happen, how soon it's going to happen, but he has to manage the hotel. What does he do? Well, he might try to sell it, but at least in finance, we assume that other people know the same thing you do, so you can't really sell it for a lot more than it's actually worth. A second thing you might do is that you might decide not to do a big expansion or a big upgrade of the hotel, because the payback period might be relatively long compared to the lifetime of the hotel. So if you underinvest in the future, that saves you some money. So your cash flow actually is going to be bigger for that. So you might look more profitable temporarily because you're not investing as much. But that would be rational in this case. It might also be that other hotel owners are doing the same thing, and so the supply of hotel rooms may be reduced, and that will drive up the price even more, some monopolistic component to this. So one of the things that you might expect is that the cash flows of this hotel might actually be improved by good management, even though there's a risk that it will be destroyed. Well, maybe we should think about the investors in this hotel. What are they doing? The owner of the hotel might sell shares of stock. Would anybody pay for shares of stock in this kind of a hotel? Answer is yes, because it's producing cash flow. You would expect cash flows now, and maybe they're fairly substantial, but they're going to end at some point. Does that mean that you're not going to want to invest in this hotel? No. What it means is you're going to calculate the amount you're willing to pay as what we say the present discounted value of the expected cash flows, as long as this exists. And so there is definitely value to this hotel, even if it's temporary. So we would have investors, and they would be happy with their investment, even though it's got a finite life. So will the stock fluctuate over time? Yes, it will fluctuate. If for some reason the end looks like the sea level is rising more slowly, or somebody builds a seawall, the value of the stock might go up. If demand for luxury goods goes up, the hotel stock might go up. And conversely, if demand goes down and the expiration time comes shorter, the stock will go down. So it's going to behave like an ordinary stock, but the risk factors are a little bit different from the ordinary case. So I'm going to give this a name. I'm going to call this termination risk. Termination risk. It sounds kind of final, doesn't it? But when I use the word risk, it means you're not sure it's going to happen. You don't know when it's going to happen, but it's a risk. And we use risk in lots of ways, and this is a great example of long-run risk. And it's an example that I think will be useful in understanding the fossil energy sector. So there are a couple more characteristics of termination risk that I'd like to just mention now. I mean, the first one is the economist way of saying this, that when you invest in any kind of asset, you get payback the first year, but you get payback in the future too, because the asset, because it's capital, will maybe depreciate a little bit over time, but it has a lifetime to it. And so if you think there's going to be a termination date, you don't want to make your stranded asset too big. If you reduce your investment now, you're likely to not have as much value that gets stranded by the events. If output increases, as I said, you might be tempted to increase the supply of rooms. However, if termination risk is not too far away, you probably won't increase the supply very much because you only have a few years of increased benefit. So we might expect to see terminating industries not have very much of a supply response, have a pretty inelastic supply curve. What's going to happen to insurance? AIA is an important insurance company who must have a good answer to this, and I think the answer is that the price of insurance is going to start off fairly high and go up over time as you get closer and closer to the termination point. It's not clear whether this does the hotel owner any good, but it's what the actuarially fair value of the insurance would be, and assuming that you don't have a regulator that is so pig-headed that they won't let you have the price increases. And finally, when a small number of firms face termination from the same event, there might be reasons for them to collaborate. That is, they might reduce their supply together and get increased monopoly rents in the temporary time till it's over. And so I think that you might expect to see some consolidation of these hotel owners to possibly achieve economies of scale, but certainly to make the reduced supply an orderly response to the climate change. So take this package of behavior and let's talk about fossil energy companies. Does this really describe fossil energy companies? Well, I would say most of us think probably not, but let's give it a try here. Here's a picture of what the International Energy Association thinks the future of fossil energy looks like, at least in power creation. Coal is dark blue, pale green is natural gas, and oil is green. And what these are, it talks about different phases of what you might expect to have happen in order to get us from where we are today, which is really basically the peak in this picture, down to zero by 2050 if we have a 20-0 global target, kind of like the Paris Agreement has suggested. The CEO of this energy company is going to say, it's pretty unlikely that we're going to do this. But there is a risk that it'll be successful. And there's also a risk that it'll be half successful. So I need to be careful in managing my company with this chart in mind. I mean, the other chart that he might be looking at is there is a massive growth predicted for renewables. Again, we might or might not be on this trajectory, but one of the things that the CEO might do is decide he will actually start trying to green up his hotel. So maybe the hotel owner decides he's going to start making electric vehicles. As an investor, are you going to be happy with this? Or are you going to say, I don't think he knows how to make electric vehicles. If he doesn't know how to make electric vehicles, he's just going to waste the money. I'd rather have it back in my pocket and have my own choice for where to invest it. And I think that the fossil energy companies are not likely to be good at producing renewable energy. Or at least they may not be able to convince investors that in fact they're a nice green company now. They're not really the same old fossil company that their name was. And so I think you're not going to see a lot of fossil energy companies actually building a green arm. I think more likely they're going to create subsidiaries to do the renewable and sell them off so that they can have their own asset prices and be treated as a green investment and not worry about the fossil energy company. So what do we see when we look at the data? Well, the good news is we see coal, which has been rising up here, falling down at the end. Actually, the peak of coal looks like it might have been like 2006, something like that. But when you look at natural gas and crude oil, you see they're rising very substantially. It doesn't really look like the picture. You see renewable energy increasing, but it looks kind of low by comparison to the needs. And nuclear power is kind of stable. So the CEO of the fossil energy company may not really believe that the future is as bleak as I'm describing or as the IEA describes, but there might be still some probability that he's got to keep in mind that this could happen, and it will be those probabilities that we want to be looking at. So how would we get from this historical graph that we started with to the future graph that we want to hit if we're going to hit net zero? Well, here are 4 government policies that you might think of. And governments all over the world are trying to decide which of these things they're going to do. They might tax carbon emissions. This is what all economists innately say is the first choice. Might not really be the best, but we're taught this from the day one of microeconomics. This is the solution to an externality. Right. Day 2, solution 2 is to subsidize renewable energy. The Europeans are big on the first one. The US has recently put together a very sizable policy in the Inflation Reduction Act to subsidize renewable energy. A third is to regulate emissions. And most countries do some amount of regulation. They may regulate what the power companies can do. Many regulate what kind of cars can be driven and what kind of mileage they have to get, what percentage of EVs or electric vehicles are required, and so forth. There are many different kinds of regulation, some of which could be very draconian. You could have a government say, nobody can emit more than 0 in 10 years, and otherwise you get a giant fine or something like that. But there is a fourth policy, which really is doing nothing. But I've called it hope. So we hope that the private sector can do this on its own. That's because the private sector consists of a lot of good people like all of us who really believe in the revolution of climate change, and consumers are going to buy goods which are greener. Employees won't work for a company unless it's got green credentials. Investors and corporations are going to kind of just change their investment strategies to make them more green and voluntarily accept greener behavior. And to some extent, this works, but I don't think it can possibly be enough because it doesn't give the big financial incentive to being green that we really need from the first three policies. But we're going to talk a lot about this fourth category because, in fact, it's where we are most of the time. We are investors and consumers and employees in economies that have not taken a sufficiently serious policy step. And the policy step is what really leads us to decarbonize, and in the process creates winners and losers. So the winners and losers are the ones that can easily decarbonize, get to net zero, and the ones for whom it is very difficult to get to net zero. So we call this transition risk, and it is a parallel to physical risk. We have physical risks and we have transition risks, and one of the types of transition risk is the termination risk that we've just been talking about. So how do we think about this in terms of asset pricing? Well, in simple terms, an asset which faces a long-run risk is less desirable than one that doesn't. So fossil energy companies that face termination risk or some kind of transition risk and other kinds of brown companies have a long-run risk which makes them less desirable and makes their stock price lower. When the stock price is lower, of course, this means that the expected return is a little bit higher because for the same amount of earnings. So this is a risk premium. So you get a risk premium from owning these kinds of assets that face these long-run risks. So one strategy is to invest in assets which have a positive risk premium, so that you would invest in all these brown assets. Another strategy is to say, you know, I don't want to bear climate risk myself, so I'd like to put some of my portfolio in a climate hedge. That is, a hedge that's going to do especially well if the climate is especially bad. And what is a hedge portfolio going to do? It's going to try to be long assets which are prepared for climate change and short companies that are not. And as a consequence, the hedge portfolio naturally has a negative risk premium to it because you're going to underweight these brown stocks. So we think that in general, a hedge portfolio should be expected to underperform the market in terms of returns, unless there is news that the climate is getting worse, that climate risk is increased, in which case the hedge portfolio zooms ahead by appreciating these stocks that are actually prepared for climate change. So there is an expectation in a static world, which is that it will underperform, but in a dynamic world where the climate is changing, it might outperform. And we're going to use that information to create some hedge portfolios. Okay, so how do we construct hedge portfolios? Well, this is a family camping trip. We're working pretty hard going up this snowfield. How do we do it? We want to overweight stocks that are prepared for climate change and underweight stocks that are not. We have to decide which one's which. That is a problem. We use data like ESG data and emissions data and industry sector data and so forth to try to figure out which stocks are likely to be prepared. We might do surveys. There are all sorts of things we do to try to figure out who's prepared and who's not prepared for climate change. So that's what I think of as a fundamental approach to it. You try to think hard from the characteristics and so forth as to who are the winners and who are the losers. An alternative approach is when there is news that the climate is changing, you can look statistically at which stocks go up and which stocks go down, holding everything else, other risk factors constant. So I'm going to show you an example of each. Okay. So the first one is what we call a stranded asset hedge portfolio, which is a weighted average of 3 exchange-traded funds. It was proposed by Bob Litterman and is used as his investment vehicle for the World Wildlife Federation. And it's long the S&P 500, short 70% of a coal ETF and 30% of a broad energy ETF. Totally simple idea, but it basically says, you know, it's the fossil energy sector that's going to be faces termination risk. It's likely to go down over time, and the S&P is the rest of it. Okay, so we'll be using that for some things. The second thing is what we call climate efficient factor mimicking portfolio, and this is trying to use the statistical approach that I said was the second one. We've described this in a paper with Jean-Luc Denard, Brian Kelly, and myself. And the idea is to form dynamic, long-only portfolios with publicly available climate funds. There are hundreds of funds which proclaim their sustainability. I'm sure you have many here that are vying for your attention. We don't know which ones are really good and which ones are not. In fact, we don't even really know what the investment manager does. We know what the prospectus says, but we don't know what's exactly going on in these portfolios. So the idea is to look at their performance and figure out which of these funds is going up when there's climate news and which ones don't. So what we do is we look over a window, moving window, at the variance of linear combinations of these funds, and we look at the correlation of linear combination of these funds with the climate news that we get from the newspaper, and we form our factor mimicking portfolio by trying to maximize the correlation with the climate news and minimize the variance of the portfolio. And we do this using a year's worth of data, and then we hold it for a month, and then we do it again. So we put on our website what's in the portfolio each month. So it's actually an investable portfolio that somebody could use if they want to. So here's what it looked like in November. It had 3 assets in it. In December, it had 2. In January of this year, it has 2. And in each of these cases, actually, it's got California carbon allowances. So these are the allowances from the California emissions trading system, which is a cap and trade system. And so it turns out, in this case, it's in this. In fact, if I looked in the hotel room this morning, and now in February, it actually only has the California allowances in it. So that's now been sort of 4 months in a row that this has been actually a good thing to invest in. Last year, though, it was not in here at all, and this is what the weights are. Okay, so how do these things work? Well, if you look at the long-run performance relative to the ACWI, the All-Country World Index, and the S&P, you see here returns over something like the last 20 years, volatility, and Sharpe ratio. So the Sharpe ratio of the S&P is maybe 30% over the last 30 years, just to give you an idea. The stranded asset portfolio over the last 25 years has a Sharpe ratio of 35%. It's a little better, but it's certainly comparable to the S&P. The climate efficient factor mimicking portfolio is 25%. If you just shorted the energy sector, that's not as good as giving extra weight to the coal sector. That would actually have a negative return over the last 25 years. If you look at the performance over the last year, ending, I think, in January this year, you see the Sharpe ratios of all of them are really much better. This has been a good year. The market's up a lot. And these climate portfolios are up a lot. The stranded asset portfolio now has a Sharpe over 2, which is, very nice. But if you looked a little bit last spring, the one-year version of these models had negative returns from all the indices, and including the stranded asset and the climate efficient factor mimicking portfolio. If you looked a couple months later, it was a little better, but some were still negative. And so one of the things I want to talk about at the end today is, why did this happen? Okay. So just before I do that, let me just tell you what we can do with these climate factors once we have them. I mean, I've done some work to try to figure out what they are, but what could we do? Well, one thing we could do is just invest in them. These are investable portfolios. We could do that. We could invest in things which are correlated with them after you take out other risk factors. And that's a pretty simple thing to think about too. We can look at stocks to see whether they seem to be green or whether there is just greenwashing about them. In other words, are they really correlated with these hedge portfolios or not? And the fourth thing is we can use these to look at banks and actually insurance companies to see whether they seem to be green or not. In other words, the stock price of a bank is really heavily determined by its the asset mix, the asset side of its balance sheet. For many insurance companies, it's also the holdings on the asset side of the balance sheet that determine this. So investors who pay attention to this will see when climate-sensitive assets are in there that they're going to be more correlated with the hedge portfolios. And that's a way of using market data to do stress tests. So I'm just going to give you one slide about each of these applications. So if we look at these sustainable funds and we regress the returns on standard risk factors like the Fama French and so forth, and then the climate hedges, I'm going to tell you what the betas are on these climate hedges, and we can choose funds that have a high beta on the climate hedges. So here is the list of the top 10 out of something like 200 funds that we pay attention to. And we have conventional things like return, volatility, and Sharpe ratio. The next two columns are correlations with some news measures. The alpha cap M is the intercept once you regress it just on a market factor. And then the last two are the betas on the stranded asset and the climate efficient factor mimicking portfolio that you get when you regress the returns on risk factors and climate factors. Okay. So I've sorted these by correlation with the CEP. And so if I think the CEP is the best measure of climate risk, then I want to invest in portfolios that are at the top of this list. And here's Invesco Solar ETF is in the top, at the clean power, clean energy, battery tech. These are all funds which actually are highly correlated with this climate risk factor. If I do the same thing for individual stocks, if I use all the stocks from the S&P 500, which is a little more than 500 stocks, and I actually have a couple more hedge portfolios in here, and I just ask, what's the average beta on these hedge portfolios? I like to know that a green stock has a positive average beta from all the hedge portfolios. Well, on the left-hand side are all the ones that have a biggest positive beta, and on the right-hand side are the ones with the biggest negative beta. And so these are what we see as being the greenest companies in the S&P. These are the ones we see as being the brownest companies in the S&P. And you can look at this and say, well, I think this makes sense, but I'm not really totally sure. And we will be doing this in a systematic way and having this reported over time on our website. But what we're really trying to do is figure out whether this ranking is correlated with any of the ESG kinds of measures that we tend to use for portfolios. Because you'd like to think that ESG is actually a part of telling us which of these columns a firm is in. Okay, finally, banks. So we now compute climate betas for all the major banks in the world, and insurance companies, including, I think, something like 10 banks here in Thailand. And from these climate betas, we can see what the exposure is to these climate hedge funds. And it changes over time. And here's a picture. This is Citibank. But if you go on the website, you'll be able to see a picture for Bangkok Bank or Kazakhstan, or I think AIA is in there. So you can see what the climate beta has actually been doing. And typically what we see is that these betas rose very substantially during the pandemic and somewhat thereafter, because the pandemic really is like an extreme decarbonization. We stopped using oil and gas nearly as much. We used Zoom. We didn't fly. We didn't drive. And energy companies did horribly. Their earnings went down. And if you had a lot of energy companies in your portfolio, you suffered for that. Then it went down pretty close to zero, but it's kind of intriguing to see what's happening right at the end here. And by doing this on a high-frequency basis, using financial data, we actually can see this sort of thing. Okay, well, so I'm now I want to talk about the current events. Why did sustainable funds perform so badly last year? And I've kind of run out of time. So, until I get dragged off the stage, let me just try to say what I think is going on. And I don't know whether you know Star Wars, but this is the Emperor in Star Wars who says, in an ominous way. Everything is proceeding as I have foreseen. And the question is, should we have foreseen the decline in these sustainable funds? The reason they declined is because they're all underweight energy, and energy had a really good year last year. But why did energy have a really good year last year? I think you can tell a pretty good story based on termination risk. That is, they stopped investing so much for the future, their cash flows got high, they are returning lots of cash to their investors. It's a story that's consistent with the termination risk, and it's kind of a nice way to think about it. And we also see some consolidation in this energy sector, and we talk about how Exxon bought its smaller competitor. And we're thinking about that as Exxon growing, but it isn't Exxon growing, it's the competitor getting out of business and selling itself to Exxon, and there's no expansion of the energy sector, it's just changing the name. But it's consolidating, and I think we'll see more of that effect. How do we know whether termination risk is really a reasonable explanation? We could look at the price-earnings ratios and the price-to-book ratios. For the price-earnings ratios here in 1921 and 22 and 20, energy is the bottom sector. For the price-to-book ratio, energy is the bottom sector. If you look January of this year, these are now sorted by PE. Energy sector is 8.38, technology is 38. You can think about this as how many years are left of earnings. 8 years. Okay, so the market kind of is saying, I don't think there's a long-run future here. The earnings per share grew by 26% over the last 5 years. It's predicted to grow by 1% over the next 5 years. This is consistent with this termination risk hypothesis. And you see coal is got the lowest PE of any. Refining and marketing of natural gas is there. Oil and gas integrated are there. Anyway, okay. Now, if I can just keep going just for a couple of minutes, I want to talk about countries. Countries face big risks if their biggest industry terminates. So termination risk is actually a country effect if you've got really just one big industry in your country. And so let's think about the Middle East. The Middle East sees that their oil and gas business may not last forever. What do they do about it? Well, they're taking all their earnings. Some of it they're giving back to shareholders, but I think a lot of it they're using to develop diversification within the economy. They're diversifying into entertainment, airlines, education, a lot of golf tours, World Cup. I mean, there's a lot of things that they're spending money on. I don't know whether this is money well spent, but that's what they're doing. This is really a real thing for them. How about Russia? Well, Russia also has its major industry is oil and gas. And so Russia is also facing termination risk in its major industry. And what is Russia going to do about this? Well, I think they have restricted supply, but I think they're also trying to diversify, and the invasion of Ukraine, I think, is part of that strategy. If they bring Ukraine on, it brings them a diversity of businesses, and I think they miscalculated that thought it would be easy, and it's not easy, it's hard, but I think this is what they wanted to do, and this is why I think they wanted to do it. They should do it now, I would think, because their oil and gas industry is worth more today than it will be in a decade, and Europe is less well prepared than they will be in a decade. So there are lots of reasons to think that it would work best if they did it now. And so I think that this termination risk idea, at least is a piece of what has produced this, inhumane war in Ukraine. What's the net effect? Well, fossil energy sales by Russia have gone down. It's not selling as much, but the prices have gone up, and the ruble has actually gone up, so that it looks like one of these fossil energy companies who are changing their responding to termination risk. So how do we feel about all this stuff from a climate change point of view? Well, decarbonization has always been something that we think is going to happen when consumers and producers face the higher costs of buying goods that are made with a lot of carbon and a lot of emissions. In other words, when you go to the gas station and you say, this gasoline is so expensive, I'm not going to drive as much next week, you're doing the work of decarbonization. If you buy a Tesla so that you don't have to use any gasoline, you're doing the work of decarbonization. If you put insulation in your house, if you do any adjustment in response to high energy prices, that's what's really supposed to happen. The other side of it, of course, is that you would like to have some revenue left to worry about the income distribution problems, because this is the impact is greater on low-income people than high-income people, but nevertheless, they are actually an important part of how we decarbonize. So, first of all, we have gotten some inflation from the high energy prices. We've probably decarbonized to some extent by people changing their behavior from these carbon prices. What would have been different if we'd actually had a carbon tax? Well, then when energy prices went up, tax revenue would have gone up as well, the carbon tax. And so there would be extra resources to use to mitigate income distribution issues, or to reduce some of the kind of tax like a regressive tax. And so we would not have seen these sustainable funds do so badly, because the energy stocks would not have gone up as much if they had to pay taxes on all the excess profits that they were making. But we didn't do that. We still probably could. But what do you think we should say now about investing? Should we no longer invest in sustainable portfolios, or is it still a good thing to do? And I think the answer is, from a hedge portfolio point of view, there's no reason not to invest in the same portfolios. That is, we still think if the termination date gets closer, that this portfolio is going to appreciate, and if it goes further out, this portfolio is going to depreciate, and that's what a hedge portfolio is supposed to do. So, and then of course it does turn out that you would have done well from last year to this year by being in this portfolio already. So, in a sense, I think that Putin has accelerated our rate of decarbonization. But the Biden bill, which subsidizes renewables, has also accelerated our decarbonization, and so has the EU Green Deal. So that, I think that this whole story does actually lead us in a pretty good climate direction. The fact that fossil energy firms, think termination is a realistic possibility, actually is going to make it easier for that to happen. So I guess a final speculation. What about termination risk for the planet? We do think there's a possibility that the planet will face termination, or at least our species will. And so what kind of policy should we follow to avoid that outcome? And I think the recommendation out of the Paris Accord is that if we can all get ourselves to net zero by 2050 or something like that, then we will avoid the worst consequences. At least the science thinks we would avoid the worst consequences. But how do you get countries to do something like this? How do you make sure everybody does it? And I think the answer is we can't make sure everybody does it. But if the largest emitters do it, if the US, Europe, China, and maybe India actually can work together to decarbonize those 4 economies, then I think the rest of the world will mostly follow suit, and a few countries which will hopefully not be big emitters may not. But that's my hope as to how this is going to happen. So I think the collaboration between major countries on this topic is incredibly important, because it's got to be, if you do it, I'll do it too. It's kind of a 1-on-1 or 1-on-2 or 2-on-3 kind of deal, because otherwise we're not going to come out of this very well. So here are 3 of my grandsons looking out over a pretty quiet lake. They wonder what kind of world we're leaving for them. And if we can figure out how to solve these problems, then they'll be a lot happier. So thank you.
Big round of applause for Professor Robert Engle. Thank you very much for that amazing presentation, some very insightful information you have given us today. I wish we had more time for you, sir. Anyways, please remain on stage with me as we proceed to the Q&A session.
Okay,
all right?
thank you.
So for those of you who haven't sent in your questions, please make sure that you scan them in through the QR code, which is right on the table. สำหรับแขกผู้เกียรติท่านใดนะคะที่มีคำถามจะถาม Professor Engle นะคะก็สามารถสแกนคำถามผ่านทาง QR code ที่วางอยู่บนโต๊ะได้เลยนะคะ Okay, so let's move on to our first question, shall we, sir?
Okay.
ขอคำถามแรกเลยนะคะ ส่งกันเข้ามาได้เรื่อยๆเลย
Thank
นะ
you.
คะ
Yeah, that's a good idea.
Okay, so here is your first question, sir. You can enjoy your drink as I repeat the question for you.
Oh, sorry.
sorry for interrupting, sir. You have touched on bank exposure. How about the insurance sector? What do you think there should be in the adoption of climate risk modeling in insurance products? If so, could we or should we benchmark our risk and pricing profile? When you're ready, sir.
Clearly, the insurance sector is the industry most impacted, or in many ways, by climate change, because at least the property and casualty business is subject to the physical risks that we're talking about. But it's also true that the insurance company has very large balance sheets which hold assets on the asset side. And so they have sort of 2 ways they can be exposed to climate risk. And then, of course, another complexity, which I don't really know how this works in Thailand, but in the US anyway, we have a lot of insurance commissioners, some of whom have decided that they don't think insurance companies should be able to raise their rates as much as the risks are going up, and consequently insurance companies are considering pulling out of regions and leaving homeowners uninsured and businesses uninsured. And this is, again, another kind of public policy issue that comes up. So my feeling is that the insurance company certainly has to start doing actuarial calculations based on forecasts, forward-looking actuarial calculations, not just looking at the historical frequency of accidents. And I think that's kind of what the climate risk modeling in this question is about. I also think there's a lot of interest, and I heard it from several of you today, in the insurance company not holding assets which are exposed to climate risk. And that is an example of, for example, not holding assets which have a lot of emissions. So can you get to net zero emissions on your asset holdings? I think if the private sector takes this under its wing and tries to do this, it is a step in the right direction. I don't think it's enough of a step without the public policy increasing the incentives to do this. I think the incentives to do this have to be more than just goodwill. It has to be, in fact, monetary incentives for not holding green companies, brown companies. And what could those incentives look like? Well, if we did have a carbon tax, for example, then fossil energy companies would not look as profitable. So you wouldn't be so inclined to put them on your balance sheet. It just takes care of itself naturally. So I still like the idea of a carbon tax. I also like the idea of subsidizing renewables. And I think coupled with both of those, we do need regulation. But I'm not really a big advocate of the fourth option of hoping.
All right, well, hope that clarifies the question for you. On to our second question. Could you suggest Thailand about the strategies for implementing carbon pricing in the country?
Well, I don't know exactly what the obstacles to carbon pricing are here. At home, they're political, and I don't know whether they're political here or not. I think one of the things that is very important is if the electorate really believes that it's important to do something about carbon pricing, they should make themselves heard when we have elections, so that elected officials feel like they're doing what their constituents want them to do if they do put a tax on carbon. I think there are ways to start carbon pricing fairly painlessly. That is, you can set up a carbon exchange and have it be just associated with the electric power industry, for example, which is much more minimal. At the beginning, you tend to give, grandfather certificates to the big emitters from the past, but you promise not to do that forever, and then you gradually reduce the number of emissions that are given out, so that over time it gets more and more effective. So that's kind of the soft approach to putting a price on carbon, and it's probably what I would suggest probably for Thailand if that's possible.
All right, sir, I'm afraid that's all the time we have for our Q&A session. So another big round of applause for Professor Robert Engle. Thank you so much for honoring us with your presence here today. And I would like to invite AA executives on stage for a brief photo opportunity. And to present a little token of appreciation
here.
to Professor Engle, right in the middle, sir. Let us welcome Dr. Narongchai Akharaseni, independent okay. Mr. Nikhil Advani, CEO, AIA Thailand. Thank you everyone once again for joining us today at the AA Nobel Laureates Luncheon Talk on the occasion of Japan-ASEAN Bridges event series facilitated by the International Peace Foundation. Now through the 2 talks in this series, we've explored personalized medicine as well as the financial implications of climate risk. Not only is AIA the largest pan-Asian life and health insurer, the company is also an investor and an ESG leader with a dedication to create a more sustainable future for everyone. Here's a little token of appreciation for you, Professor Robert Engle. Thank you so much for being with us here today. Okay, a big round of applause for Mr. Nikhil Advani, CEO of AIA Thailand, and also Professor Robert Engle. Now, with this in mind, ladies and gentlemen, we look forward to, thank you very much, sir, to fostering more cooperation in the healthcare and financial communities to build a better tomorrow for all. Now, on behalf of AIA Thailand, I would like to express my deepest gratitude to everyone for honoring us with your presence today. ในนามของ AIA ประเทศไทยนะคะดิฉันต้องขอขอบพระคุณแขกผู้มีเกียรติทุกท่านนะคะที่สละเวลามีค่านะคะมาร่วมงานกับเราในวันนี้นะคะแล้วก็หวังเป็นอย่างยิ่งว่าความตั้งใจนะคะของ AIA ในการจัดงานในครั้งนี้นะคะจะเป็นส่วนหนึ่งในการขับเคลื่อนนะคะให้เกิดความร่วมมือกันนะคะระหว่างวงการต่างๆค่ะแล้วก็ส่งเสริมให้คนไทยนั้นมีสุขภาพที่ดีต่อไปนะคะดังคำมั่นสัญญาของ AIA ที่ว่าเพื่อสุขภาพและชีวิตที่ดีขึ้นนะคะ healthier longer better lives สำหรับวันนี้นะคะดิฉันนาขวัญรายนานนท์นะคะคงจะหมดหน้าที่ลงเพียงเท่านี้นะคะหวังว่าจะได้พบกันใหม่ในโอกาสหน้านะคะแล้วก็ขอให้ทุกท่านเดินทางกลับโดยสวัสดิภาพนะคะ Thank you very much ladies and gentlemen สวัสดีค่ะ
คุณรู้ไหมว่าคุณจะมีโอกาสอายุยืนยาวถึง100 ปีด้วยนวัตกรรมทางการแพทย์ที่ก้าวล้ำทำให้มีแนวโน้มที่คนจะอายุยืนยาวขึ้นเรื่อยๆตลอด6 ทศวรรษที่ผ่านมาคนไทยมีอายุขัยเฉลี่ยเพิ่มขึ้น 4.4 เดือนต่อปีและคาดการณ์ว่าคนไทยที่เกิดในปี 2559 มีโอกาสที่จะมีอายุเฉลี่ยเกือบถึง 90 ปี หรือบางคนอาจไปได้ถึง 100 ปีดังนั้นการที่คนไทยจะมีอายุถึง 100 ปีกำลังจะกลายเป็นเรื่องใกล้ตัวที่เราต้องเตรียมพร้อมรับมืออย่างชาญฉลาดแต่การมีชีวิตยืนยาว